Hey everyone, we are live. We are live again. Today we're going to talk about the Federal Reserve and their decision to pause rates for the time being and how this affects the markets and what should we expect from this. And so I'm just here doing my little Mr. Burns thing, trying to figure this out. So we're going to get into this today. Let's go ahead and kick this intro. I hope that you all are doing well, but you know, we got to hear what Jerome Powell has to say today. So let's get to it.
Think, act, and prosper. You are now tuned into the Money Level Show.
Hey, we are back. We are back. We are back. I'm feeling excited. I'm feeling energized. I've been taking care of my health, been eating better, eating less sugar, feeling more alert, feeling more like my brain isn't foggy, feeling like I'm processing well. It's just a good feeling. So I'm excited. I'm excited. I did just get my new book in from Miss Lynn Alden, Broken Money. It's a huge book. Lynn is very smart. She's come on my channel one time. This was back in 2021 when my channel was a lot smaller and a lot younger. And so, but I'm grateful to be able to have her book and hopefully get an autograph at the New Orleans Investment Conference, along with a interview. But we shall see. Got my guy Max here. Salute. Appreciate you, bro, for being here with me today. I'm going to shoot you a text back. I got your text message. So thank you for reaching out. And we'll definitely get to some stock picks and such. And so today we're going to look at what did the Federal Reserve do today, because they did pause rates. And so I want to look at a couple articles and then also give you my take on um, how does this interesting time play out. And so let's go ahead and get it in. We're going to start with a article from Yahoo Finance. The article's titled "Stocks Slide After Fed Pauses, Hints at Higher Interest Rates for Longer." Stock market news today. Stocks moved lower Wednesday as Wall Street digested the Federal Reserve's decision to hold interest rates steady, yet forecast one more rate hike to come in 2023's final two meetings and hinted they could stay higher for longer. So, what does higher for longer mean? That means that they raise interest rates, they pause for a certain amount of months. This could be anywhere from, 5 months, 6 months, whatever, 8 months, a year. They stay at a higher rate and then they cut rates whenever the economy really starts to tank. And so that is pretty much what they do, right? They try to destroy demand, right, by keeping interest rates higher for longer, which means that you're going to pay more interest on your debt, more interest on your credit cards, more interest on all of these different things that you may have taken loans out on, right? And you're going to be having a lot of your capital sucked away, right? The banking system is going to come take a lot of your capital and such. And so, which reduces demand. So you're not going to go out and spend as much money because your interest rate is high. So if you're paying, let's say $500 a month in interest on your credit card, you're likely not going to be spending money on things that you don't need, right? And so, unless you default on your credit card, which I am not suggesting that you do, but that is how it works. So, higher for longer means that you have to pay high interest for a long period of time. However, another component of this is that I've heard many times that interest rates are cyclical, and we are likely to be in a rising interest rate environment for a long time because the Fed cannot, they cannot pretty much um, cut rates in a way or print money because inflation is going to get worse. So that's another take right there. Right. So let's get back into it. Um, Wall Street's focus on the Fed turned to what would happen in the future, whether it will return to raising borrowing costs this year And when a rate cut could be in the cards, the central bank signaled one more hike would come before the end of the year. And it updated its forecast for the benchmark interest rate to show interest rates will now remain higher for longer than previously anticipated. So that means more pain, more pain, more pain. The recent soaring rally in oil prices, seen by some as a risk to the Fed's effort to cool inflation, pulled back on somewhat Wednesday as investors weigh how policy decision might affect economic growth and fuel demand. All right. So as we can see, the Fed, they pause rates for the time being. They're planning on doing another rate hike this year, and then they're going to stay higher for longer. So the markets could be in this weird place where it doesn't really move one way or the other because or it could chop sideways because, the Fed is just keeping the rates, pretty much unchanged. And so we're going to jump over to Jerome Powell's speech, right? Actually, we're going to jump over here first. So this is the CPI inflation, which is it shows the CPI. Obviously, 2020 was at 0%, then went up to a little over 9%, and then came back down, still away from their target of 2%, and it's bounced back up to 4%. So the question is, okay, is CPI trending back upward because the Fed cannot, create supply? I mean, because there's supply shortages, especially in a lot of energy, agriculture. I mean, we go through all of the commodity sectors. I mean, not commodity. We don't go through all the commodities, but we go through a lot of them, right? Agriculture, energy, things of that nature. And energy is rising. The price of uranium is rising. The price of oil is rising, right? You got the price of food rising. I mean, the price of diesel is rising. And a lot of the CPI does not factor in many of these costs and how it impacts the economy. So CPI should be a lot higher. I mean, we can go over to shadow stats. Let's go look at shadow stats to see what they have the CPI at. They measure it based on the 1970s and 80s method of inflation. So currently, they have the CPI rates at around, this is the 1990 base, which is, they have it at a little less than 8%. And they have, this is the CPI that the government official CPI or whatnot. And they have this at, close to 4%. So yeah, so they have it as double that. So pretty much that is the 1990s method of measuring inflation, and then you have the 1980s method of measuring inflation, where they have the 1980s method at still over 10%. And so they used how they measured it back then, and that is why the numbers are higher, right? And so if we're going to compare, inflation now to the 80s, we would be over 10%, 12%, pretty much. So that's important to note, right? So we're going to go ahead and jump over to Jerome Powell's speech and see what he had to say. All right. What did this clown have to say today? That was mean, but it is what it is. All right. Let's go. All right. Hang on. Let me get this right.
Next year, but with the
Let's listen to Mr. Powell. Thank you, Greg.
Focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt.
All right. So he's talking about the quantitative tightening, which is obviously the selling the debt off the balance sheet. and raising interest rates. That is how they have tightened monetary policy. The issue that the Fed is facing is that while the Fed is tightening, the government is still loosening. I mean, we still have a $2 trillion deficit in our budget, a budget deficit, and they are still spending money. I mean, the debt ceiling is suspended until next year sometime. It doesn't say how much they can run the debt up or whatever. Like, there's no cap on it, so they're going to keep spending money. So the government is providing liquidity to the markets and to the economy by, obviously their paychecks that they send out, social security checks, and all of those different benefits. And they're talking about raising the cost of living adjustment next year. So they're going to raise that amount as well. So that's going to be more spending while the Fed is tightening, with interest rates and selling debt off their balance sheet. So it's kind of they're countering each other right now.
Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we're in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate. Our decisions will be based on our ongoing assessments of the incoming data and the evolving outlook and risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. And so far this year, growth in real GDP has come in above expectations. Recent readings on consumer spending have been particularly robust. Activity in the housing sector has picked up somewhat, though.
So he's talking about how they're trying to fight demand, but demand keeps rising, with consumer spending, the housing sector and such. And so, and he talks about how it comes with a lag. Many people that I brought on the channel talks about how, like, when the Fed starts raising rates and they pause higher for longer, like, the effects of that comes with a lag. So some people are saying, okay, we may see a recession by 2024 Q1, Q2 2024, but obviously they can't predict when it's going to happen, but that is pretty much usually how it works. It's like the higher for longer causes more pain and such. And so, but you have this interesting part with the federal government still spending a lot of money right now. I mean, we just had Zelensky here. He coming here asking for more aid and stuff, you know what I mean? Like, okay, I don't know who cut the check, and obviously it's going to come out of our tax dollars or whatever. I don't know what's going to happen with that, but I'll be interested to see what comes out of that. But the Fed is being fought with other forces of spending and liquidity, and so it's pretty much just balancing each other out.
But remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP, committee participants revised up their assessments of real GDP growth, with the median for this year now at 2.1%. Participants expect growth to cool, with the median projection falling to 1.5% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers.
So he's saying, like, a lot of things that are countering what they're trying to do. So he's mentioning a lot of government statistics. Now, if you believe the government statistics, that's a different question, right? But he's saying, like, all of these things with job growth, wage growth, all of these different dynamics are staying pretty elevated, and they're not seeing like any impact in there yet. And so this actually probably contributes to why they're going to stay higher for longer, because, like, okay, like, none of these numbers are changing. I think the Atlanta Fed GDP is still pretty positive or high or something like that. I think they're still elevated um in their projections on GDP. So the Fed is saying, like, hey, these parts of the economy are still strong, and it sounds like they're probably going to stay higher for longer.
FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises from 3.8% at the end of this year to 4.1% over the next 2 years. Inflation remains well above our longer run goal of 2%. Based on the Consumer Price Index, or CPI, and other data, we estimate that total PCE prices rose 3.4% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 3.9%. Inflation has moderated somewhat since the middle of last year, and longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Nevertheless, the process of getting inflation sustainably down to 2% has a long way to go. The monetary policy actions are
sorry about that. So he says the process of getting inflation to 2% has a long way to go. So how long does it have to go, right? And so I think that's more confirmation of the higher for longer narrative that they're pushing.
Reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. We see the current stance of monetary policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses. In light of how far we have come in tightening policy, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to our 2% goal over time. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects.
I'm sorry, y'all. This gets kind of boring after a while. I'm sorry, but he's saying he's repeating a lot of stuff. So we got a couple comments we're going to look at. The cap came through. The cap said, all because they didn't raise it doesn't mean they won't in November or December. I don't think we'll get to 6%, but 5.75. Yes, and I agree with you on that because they mentioned that they were hinting at another rate hike for the end of this year, before the end of this year, but they were going to pause and remain higher for longer. And so we'll see. I mean, if inflation keeps going up, if inflation keeps ticking up and energy keeps ticking up and such, then I think that they may have some more rate hikes in them. So it just kind of depends on what happens. I mean, this last time with inflation, we went from 3.2%. And I think it was July, and then August we went to 3.7%. So that ticked up. If it ticks up again, and then I think that they may change the tune on the pause or anything like that. But they did pause for this time, but they plan on doing one more rate hike in the future. So appreciate you adding that point. And if rates do go to 5.75%, I will happily buy some treasury bills. I will not loan the government money for longer than 2 years, or matter of fact, 1 year, right? But 5.75%. I mean, you could probably get a treasury bill at close to 6% at that point. So that's a good low risk investment where you can earn money on your money. My guy GoFlow is in the building. What's up, GoFlow? Good to see you. Good to see you. And obviously, my guy JT Coin Rings is in the building as well. So it's interesting because Jerome Powell talks about how inflation hurts the average person, and it's interesting to hear him say that because ultimately their actions is what caused inflation. How much money was printed, the money was given to the bigs, right? Given to the bigs. The bigs were able to spend the money first before it even trickled down to the average person, and inflation's running hot by the time the average person gets the money. So like when we had the pandemic, if you're buddy with the government, you're buddy with whoever else, and they decide to pass some type of policy or such, then to give funding, to people, then if you're buddies, right, you're likely going to get that first. So, I mean, the banks are going to get that first before we even see any of that, right? And so the Fed's policies is what's been hurting people, right? And so, I mean, right now they're in a situation where they're damned if they do, damned if they don't. Now they stuck, right? They're stuck because the higher interest rate is going to hurt people, and the high inflation rate is going to hurt people. So if they cut back on spending, I mean, if they cut back, cut rates or whatnot, I think that inflation is going to go higher. Like if they start easing again, I think inflation is going to go higher, and it's going to hurt people even more. This is a good book here from Nomi Prince. It's called Permanent Distortion, where she writes about how the Fed and the bankers actually, this book right here, I encourage you all to check this out. From Nomi Prince. She worked at Bear Stearns. She worked at Lehman Brothers. She worked at Chase Manhattan before it was acquired by JP Morgan. She worked at Lehman Brothers. I think I said that. And she worked at Goldman Sachs. And so she talks about how the Fed has caused a permanent distortion in the financial markets and how they've hurt the real economy with their policies. And so this is a great book. I have not finished the book yet. I'm still reading it, but I have Nomi Prince coming on next week on Wednesday to discuss her book and to talk about some of the key points she made in here. I mean, like even like it's so good. The book is so good. I'm just going to read just a quote that she uses from the first chapter. She says, let's see, the first chapter, she uses a quote from Isaac Asimov. She says, well, not she says, but Isaac Asimov says, what is really amazing and frustrating is mankind's habit of refusing to see the obvious and inevitable until it is there, and then muttering about unforeseen catastrophes. And so she talks about like she goes deep into the financial system, the banking system, and all of that. And so we're going to have an interview with her next week. So I encourage you all to grab this because it really just shows the importance of why you want to own gold and precious metals, and why you want to have, I mean, she's an advocate of gold. I mean, why you want to have money outside of the financial system, because they are rigging this market, and their decisions hurt people. They're hurting people. I mean, the dollar's value continues to lose money, right? It continues to lose value. And yeah, it's just a mess. So we had Neophyte, my guy here. Interest rates will be high for the next 10 years. Time to get debt free, right? I don't know how high interest rates will be and for how long, but I do know that it's they happen in cycles. From what I've been researching and such, and so it'll be interesting because the Fed is in such a tight spot, right? They're in such a tight spot that if they keep interest rates high, obviously savers win. I mean, people that save, they can throw money into a treasury bill and get, 7, 8%, depending on how high rates go. At some point, the bond investors will win. I mean, just think about it. Like if you could buy a 30-year bond in 1982 and interest rates were at, 20%, and you could buy a bond that's paying you, 18, 19, 20%, over 30 years. Like that was a huge bond bull market, and that has been trending down for a long time. So interest rates have been declining for over 40 years. Rick Rule talks about this all the time. And it's unsustainable now because the lower interest rates are, the more people can borrow, the more corporations can borrow and incur debt, right? And the money's just cheap, and the more value we lose in our money, right? And so if interest rates are low, it's going to cause a lot more I think a lot more inflation. Now the inflation cat is out of the bag, and so if we go back to easing and such with cheap money, and everything, I think that inflation is going to stay elevated. So, it's really a damned if you do, damned if you don't situation for the Fed. They are really stuck. And I think that, either way, either we are going to have to deal with higher interest rates for longer or deal with higher inflation for longer. And so, but the issue is like they're not really addressing inflation, right? We know that the supply of oil and the supply of commodities are still very low. Like, I mean, we're like dragging our feet to get these commodities, really flowing. So when you think about that, it's just wild, I'm just going to share my screen really quick, but about in terms of energy. I appreciate everybody for being on. If you here, you have not subscribed to the channel yet, be sure to hit the subscribe button, hit the like button so that this video gets out there. I appreciate you all for joining me tonight. So I'm just on Twitter, or X, formerly known as Twitter. I just saw this interesting. This is from Amy Nixon. She's a housing expert. But she says this home sold in 2021 for $685,000. Buyer's monthly payment, is 3526. Buyer's monthly payment today, 8402. But wages went up, but people have cash now. No, this is complete insanity. Stop pretending it is not. So the house sold for $685,000 in 2021. It is listed at $1,075,000 right now. So she's saying like, oh, wages went up. Like, if wages went up, how could you afford how much did wages go up, first of all, right? And then when you look at the amount of the monthly payment, this more than doubled. So like unless you got a 50 unless your salary got doubled, right? Then you're losing purchasing power, because now this payment is 8,400. And so because of high interest rates. So that was pretty alarming right there. People hurting. I'm just going over to my guy Josh Young's page because I wanted to show the chart that he had put up, which this was a chart he put up, a little while ago. But U.S. crude inventories, including the SPR, are down to its lowest level since 1985. So supply is not increasing. Supply is not increasing. We're going to look at some more charts, right? We're going to look at some more charts too. So supply isn't increasing. I mean, since 1985, think about this. I mean, our population grew how much since 1985? And then we have the same amount of of inventory as 1985, right? So that is a important thing to look at. So supply isn't coming on. Commodities are still going high. Uranium is still going higher, right? Because we have not increased supply as much as we need to. So I'm going to look at the rig count chart. These are the oil rigs. I think they have them on the Fred. Let's see. This may be a good one. All right, so here we go. Let's go ahead. These are the oil rig charts. Let's look over the last year. Oil rigs have been going down. So I mean, we had 620, and now we're at a little less than 520. So we've lost over 100 oil rigs since then. So if that's, I think that's in 2620, right? I don't see any other another key over there to say it's different, but yeah, so we've been losing oil rigs, so that's not increasing production. All right, so inflation is just going to keep staying high. All right, that's what my take is on it. Inflation will keep staying high. Let's see. Got my guy Logan here. Keep up the good work, bro. Spreading financial knowledge is awesome. Much love from an old friend from Oklahoma City. Yes, indeed. Hey, it's good to see you. Logan, well, I don't see you. I mean, you don't have a picture on here, but appreciate you tuning in and everything, brother. It's been a while since we've engaged with one another. I'm sure we've grown a lot in multiple different ways, but love to catch up because it has been a long time. Appreciate you tuning in and watching as well. Let's see. Capped. If anyone is looking for some straight up / no BS data on the economy, I highly recommend Clear Value Tax YouTube channel. Straight facts from a CPA that has been very accurate on the markets. Yes. I really like Clear Value Tax. I forgot the guy's name. It's Jason or something, but I've been watching him since like he would come out with the stimulus stuff. Like he would always, I mean, he just really, when the pandemic hit, he just took it to another level where he was giving people the information they needed. He was weeding out and filtering like through all the jargon and stuff and bringing it straight to the people. So I really like Clear Value Tax as well. So appreciate you bringing that up. And yeah, his channel keeps growing. It keeps booming. So this is my take on the, it's Brian. Yeah, Brian. Yep. I think it's Brian. Yep. So I remember watching Brian quite a bit. I got to go back and tap in with more of his stuff. So appreciate you all for joining me tonight. I hope you all are doing well. I got some exciting stuff coming, you all. Like I got some more videos I'm going to be uploading. Be sure to check out the shorts I'm uploading and everything as well, because I'm doing some creative shorts. I do have my hip hop financial shorts coming soon as well. So I'm going to be pushing those out. And then if you have not yet, be sure to check out my affiliate opportunity with Miles Franklin, because Miles Franklin does deal with bullion. And if you buy through them, you support the channel. So I'm going to go ahead and play a quick commercial from them. Don't go anywhere. Just listen to the commercial, consider it, and, buy some metals to protect your wealth, right? Hey everyone, sorry for the break in action, but I have to let you know that I am now an affiliate with Miles Franklin. Miles Franklin has been a bullion dealer for over 30 years, and they provide some of the highest quality service to their clients, as well as fair pricing on bullion products. So purchasing bullion through Miles Franklin not only stores wealth for yourself, but you're also supporting this channel to continue to provide free educational material for retail investors and those who may not be aware of many financial concepts that I discuss on this channel. So you can get started by sending an email to info@milesfranklin.com or calling 952-929-7006. Be sure to let them know that Daryl Thomas or the Money Level Show sent you, and I will receive credit for your service. I thank you all for considering this. Now let's get back to the interview. Yep, let's get back. So I've started buying metals again. I just need to have more. So with my metals journey, I went from zero metals. Then during the pandemic, when money was just flowing just everywhere, I ended up accumulating probably about 70,000 in metals, and it was a lot. I had a lot of numismatic coins and stuff, and I had to go back and cleanse all that stuff. I had to cleanse my metal stack because I realized, okay, I'm buying all these collectors coins and things of this nature, but they are have very high premiums, and you can't sell them for what you actually paid for them. Oftentimes, so some of them you can. I do have some pieces that are like, okay, I know this is going to sell for way higher than I got it for, but just because the mintage was low. So I bought a lot of that stuff. My guy JT right here, he knows. I was just going to share this a little more, but JT knows. JT was on one of my Facebook groups with me, and he would see me going just like, "Oh, Ben this, buy it now, buy it now, buy it now," and everything. And I ended up having to sell a lot of my metals, like because it was just I had too much numismatic stuff, I had too much collector stuff, and I was like, yeah, I need to get rid of some of this stuff because like I'm losing money, and all these things, so it was just a nightmare trying to get through that. I had to take losses on them. And so yeah, it's a lot. So I'm back to restacking the metals because I mean we got to be prepared, you just got to be prepared. And I'm really trying to diversify that. And so my guy Max, I have about 160K in metals. Yeah. I've been stacking for 2-3 years. Man, you gotta slow down, bro. You got enough. You got enough. I remember I had Rick on. I told him I had probably like what 70% of my net worth was in metals. He was like, "Yeah, Daryl, that's just too much." He was like, "That's too much. You need to invest in your business so that you're generating more income and such." He's like, "That's too much." So I went and sold a lot of them. But I'm back to the restacking. I'm back to the restacking because I need to just be sure to have more and more ready. I've been doing junk silver. I just started doing American Eagles, American Gold Eagles. I got some good deals from some friends on that. I'm really like a barterer, y'all. Like I go out, I have friends all over Facebook and stuff, and I find them for the cheap, right? And so and obviously Miles Franklin, they come out with deals every Monday, and so I'll be pushing those out too. But yeah, so you can get some good ones. Hey, so so Neophyte said, Henry said, God damn, right? Yeah, that's a lot of metals, man. But it's a good way to like stack wealth and like, preserve your purchasing power. It's a good way to stack wealth and preserve your purchasing power. I mean, like metals are a little bit harder to liquidate. I think, well, for me, it used to be harder to liquidate, but now that I know more people that are willing to buy and that buy to resell, like it's easier to liquidate now. But it's just about if I want to liquidate at the price they're willing to offer me. Yeah. So that's kind of what it comes down to now. Um, so my guy Neophyte said, what do you think about silver's performance year to date? Looks like we're staying around 25 an ounce. It's down 80 cents with a high of 26 and 25 and a low of 20.36. To be honest, man, like I don't look at silver. I don't really look at the silver price as much or the gold price as much. Well, I look at the gold price a little more than the silver price. And I do look at the premiums on them because I know that some places charge way higher premiums than other places. And I've done my comparables and all of those things, right? But I honestly don't the reason I stack it, like I don't stack it for like the dollar gain and da da da. Like I have friends of mine that do make a lot of money um that does make money off the premiums or whatnot. But for me, it's like I'm holding it for a different reason. I'm holding it for generational wealth, like to pass down to my kids and grandkids. So I don't really look at the price too much, unless it's like cheap enough to where I will buy it. And so I don't do any price predictions or any of that stuff because like it's not really worth I just feel like it's not really, worth me doing that. I just rather hold it and have it so that if, stuff hits the fan, then I'm prepared and I'm good. And so that's what I keep it for, because it's real money. It's real money in your hands. It's real money in the Constitution, right? You know what I'm saying? Like, it's not this flaky fiat currency, these paper dollars that just go to waste and go to freaking and fails over time, historically over time. So for me, I'm gonna be buying like at $20 an ounce. I'm gonna be buying at 26 an ounce. Unless I have like a lot like Max does. But yeah, if I have a lot like Max does, I would slow down unless I see like a huge price dip, a huge opportunity. JT over here laughing. I don't know what you laughing at, bro. Somebody's comment, I imagine. Max said, that does make a lot of sense. I was talking to Tony at the bar during our symposium. You all know who Tony is, Tony Retta, who's come on the show. He is the CEO of Tectonic Metals, who is a gold exploration company. They're currently, I think, exploring a project in Alaska. Right. So he was talking with Tony at the bar back at the symposium. I told him I want to produce agricultural commodities. He said I can take some of my metal holdings and buy land. That's along the lines of Rick saying that some of these holdings could go into developing one's business to increase income. Yes, indeed. Yes, indeed. Yeah, because Rick told me that. He told me that on the show. He was like, hey, yeah, you got too much. Like, invest in your business, increase your income. Because the metals likely aren't going to move in the way we think. Like, you just think about all the narratives we hear about gold and silver. Like, obviously, the BRICS. I mean, there's something serious to really consider, but many people thought that the BRICS was going to come out with their currency in August, right? They said that they're going to look at it for next year, right? But they did not come out with the currency in August. And so you could see like people panic buying, oh, I need to buy, right? But like, we probably have time, we likely have time. I don't want to be oblivious, because you can wake up. The risk is always there where you can wake up and all things went to hell, right? You know what I'm saying? And so like it's just, you got to hold them, but you don't want to hold too much, because you can invest that capital somewhere else with discipline. Interesting, very interesting perspective. Yes, Neophyte. I don't know if you're talking about what Rick was sharing with us and Tony was sharing with us, or if you're talking about something else I shared about, but appreciate you chiming in. All right, y'all. What are y'all buying right now? Y'all buying metals? Are y'all chilling back? What are y'all doing? I just bought some silver necklaces, some chains. I bought a silver chain and a bezel with the Libertad in it. I was like, okay, let me go ahead and get a silver chain. I don't have one yet. I have a gold chain. I did buy a bezel for American Gold Eagle and stuff. So I'm kind of tapping into the jewelry a little more now. So I'm trying to do new things, like not new things, but just like diversify the types of metals. So like, for example, obviously holding physical metals is good, but, being able to, have jewelry, gold jewelry. I mean, it's a good investment, I think. All right, so Max said, Neophyte, I created and scaled a cannabis distribution company. I was also an indoor cultivator in an emerging market. I saw an opportunity, took advantage, but now I've moved on. Yes, Max definitely shared this story with me at the symposium. I think it was on the first night. I think it was on the Sunday I was there. I ran into Max. We ended up talking and everything. It was pretty dope conversation and stuff. And he was telling me some of his story and how he made money. The cap said, just chilling and collecting money. Yes, indeed. So that's a good way. Nothing's wrong with it. I mean, you can get 5% on your banks, or you can also buy treasury bills and get a decent percentage as well. So yeah, I think that's good. A good plan you got going on. Neophyte said 5 to 20% of your overall net worth. I think is a great position to have. I want to know average price per ounce. LOL. I haven't bought anything. I'm poor, paying off debt, picking up over time. Yeah, Neophyte, I understand. Definitely you gotta focus on, what you need to focus on. I think that just putting a little bit away. I mean, obviously, focusing more on paying off debt is important, but whatever you could put away. I mean, because ultimately, the way I think of it is like, if you have an economic collapse or something, right? You're not worried about your debt. Right? You're not worried about, how much you owe whoever. It is survival at that point. It is game on, right? And so your barter ability is very important, So definitely, have some on the side. I mean, because really, like I think that this stacking metals is a way that people don't get wiped out, So I mean, I have some friends with huge student loans, huge medical bills, all those things. And I'm like, how are you going to get off from under that? Like 90 grand, 100 grand, 200 grand. How are you going to get off from under that burden? I'm like, me, I would default on that debt and stack metals and have money outside of the system. Like I would not spend my whole life trying to pay them off unless I hit like a big break on like crypto or something and crypto goes to the moon and I'm like, okay, yeah, now I'm a millionaire, I'll pay them off, right? But you got to have metals so that you're protected against in the event of any type of economic collapse or anything like that, because really all that stuff go out the window. Like how much you owe whoever, like good luck collecting it from me, buddy. Right. Um, the cap said, I think there's a long way to the market and prices drop to the quote unquote bottom. Yeah, I think we're probably gonna it's probably gonna be a little while. I mean, right now things seem to stay elevated. So yep. So Max dropped the average 23.50 to 27 per ounce during 2020, 2021. Before I met my primary dealer, I was paying high premiums, but it was a supply and demand premium. I was paying 30 to 32 an ounce. Yeah, that was a lot. But you got to get in. That's the thing. It's like you got to get in. Like you don't have to go all in, but like just build some type of position so that you're protected. And I think that's ultimately what it boils down to is building some type of position. Because I paid when I got in, I think when I got in, it was in June of 2020, no, April of 2020 when I learned about it. And I think silver was rebounding, so I was getting like the gold eagles for like 200, I don't know, 190 something. And then the silver I was getting for, I think the premiums were high then. So I was paying like $30 and I was going on eBay. I started on eBay and FeeBay, right? So you got the premiums, then you got eBay's taxes on top of that. So I was paying a lot, when I first started. But then, when the prices dropped, I was able to get in. And right now, premiums are pretty cheap. So if you all, right now, even on the American Silver Eagles, like we were just paying, like people were just paying like $38, $40, $35 for American Silver Eagles, and me, I was able to find some cool little deals. I went to some local shops, like, hey, let's talk a deal, da. I got some American Silver Eagles for $28, $29, while the premiums were high, but now the premiums have come down some. So you can get some of them a little bit cheaper right now as well. So now I would say it's a good time to buy in terms of premiums for sure. Even Andy Scheckman just said like he's seen premiums come down quite a bit, with some of the lowest in the last few years. So yep. So be sure to protect yourself, man. Be sure to protect yourself. All right, y'all. So I actually JT, I still have not found, right. So this is the problem with having physical metals, Max. This is my problem here. I would store it everywhere around the house, all types of places. and I have like a container with like, how many gold? I got a bunch of gold. It's like 1/10 ounce gold equals. I got like probably like, I don't know, 10 of them, or I got a certain amount. I see the amount I have in my app, my gold tracker app, and I'm like, okay, where did those metals go? Because I know I didn't sell them. I can't find them nowhere. I think it's if it's anywhere, it's probably at the house that I'm renting out, my house that I own that I'm renting out. And so you can easily lose metals when you have them in physical custody. So at some point, which I talked to John Barker from Sprott, and he talked about the important, like the benefits of owning the Sprott physical gold trust versus, having a bunch of physical metals. And he was like, he was moving kilos and kilos of silver and stuff out of his house, and it was just getting to be too much. And so you can own the physical trust whenever you get to a certain amount where you're comfortable at home. Those are some ways that you can own, as well as have custody in other banks or whatnot, or not banks, but other custodians. Trying to learn on researching companies within the commodity space is my main effort right now, mainly from the symposium. Yep, definitely. And Rick Rule has a upcoming symposium, or no, a boot camp on royalty and streaming companies. I'm going to go ahead and drop this link in the comments section. I did receive an affiliate link for that. So, y'all could check that out. So he does have a new boot camp that is coming out for royalty and streaming, and it's on October 21st. October 21st. So I don't know if that link works in there. We'll see. You can copy it or whatever. So the cap saying, watch those videos all the loop again. Still haven't finished work night. So when I watch them, yeah. Is this the captain from the cruise? Is this captain from the cruise? Is this the captain from the cruise? Is this the same captain? He said, dang, my dude, I keep them consolidated. I had to invest them and invest in the safe, and that's its own endeavor. Learning safe technology and resistance still safe that ways. Yeah, that's good, bro. I mean, you invested in it, invested in something that's important. Okay. All right. Gotcha. I was like, okay, it was a captain that on the cruise that we were talking, building a good relationship. So yeah. Next year, man, I'm gonna be there for sure. I'm gonna be at New Orleans coming up. If you haven't checked out my link to New Orleans Investment Conference, be sure to click that as well. I mean, I get credit for that. It's in the description of most of my videos. And yes, I'm gonna be in New Orleans, and then I'm also be at the Vancouver Resource Investment Conference. I think that's right. Where the one at Jay Martin in Cambridge House puts on every year. So I'm gonna be there. That one's only about 3 to 4 hours from me driving, so I can make it up there for sure. And then I'll probably chill out and then wait until July of next year to go to the symposium. And so I'm hoping the channel grows a lot by then, so that I can be a little more well known by that time. But we'll see. All right, y'all. I'm gonna go ahead and get out of here. I gotta go get some food. I'm probably gonna go to the gym for a little bit. Feeling good. Take care of your health, y'all. Make sure you take care of your health, your physical health, your mental health, your spiritual health, emotional health, financial health, all of that. We got to be sharp, y'all. So y'all take care. Y'all have a blessed night. Appreciate y'all tuning in with me. All right.